So Rockpool Investments is a firm dedicated to helping individuals build wealth by investing in private companies. And we've taken a slightly different look at this to the traditional EIS fund or VCT. And our model is a very open and transparent route to investing in private companies without a fund. I'm sure we'll explain that a little more later on, but effectively it allows every investor to shape their own portfolio. So I suppose we look for management teams that know what they're doing. We're very generalist, and if you like, I think one of the mistakes one can make in private company investing is to focus too narrowly on a single sector. What you need to do is to recognize a good business when you see it. And so we've invested across a very wide range of sectors, but the most important thing is management know what they're doing, there's a business that's already successful, and there's a risk and a return balance that match. So asset rich, as we call it, represents a little over half of our business to date. So it's important for us, and indeed there are so many investors, I think, who find their way to EIS and for whom asset rich is the sort of natural first place. It's interesting now we're seeing people moving to growth, which is the other half of our business, where in fact there's a lot more opportunities, perhaps slightly higher risks, but when you put them together with the EIS tax reliefs, actually there's a question, are they higher risk? So a typical investment would be, for example, building a new crematorium. And we've done a number of these where the management team, who know very well what they're doing, they'd actually built 6 before we met them, but they needed capital to build more. And our capital is used to buy a freehold piece of land, to build a building, which is reasonably a simple, replicable building, and to put some equipment in it. The operating costs are quite low, and this means that the downside, the risk of the company needing further funding, there's a great predictability about it, and I think that's what investors like. Typically, after 3 to 4 years, in the 4th year, we would expect capital to be returned, either through a refinancing, and that's the great thing where there are assets, as in the case of a crematorium, or through a sale to a trade party. Again, a very wide range of sectors. It spans from catering equipment, so installing kitchens, through to performance parts for Ford cars. The range is huge, but what unites them is that they're already successful businesses. So the examples I've just covered had turnovers of £5 million to £10 million at the time that we invested. So we weren't taking a guess on whether this would be a successful business, but rather whether management could continue the success. Now, our first exit for a growth business is expected to happen at the start of next year. However, investors have had, quite a lot of our investors make loan investments as well as EIS investments, and the loan capital has come back. So, if you like, investors have already seen a tangible element of success. But the normal exit route would be through a sale to a trade party, and indeed, with the first exit, corporate finance advisors are now being appointed, and so we can see the route to exit. Again, the first exits are just coming now, so the first crematorium will be exiting in the coming quarter, as will the second investment that we made in that area. And both of those are on target. I suppose market change, regulatory change, none of us are immune to those things, and a management team that knows what they're doing can reduce the risk of you running, if you like, into something that you hadn't expected. But I suppose the most common unexpected event is that the company requires more money. And whether that's because there's been a twist in the road, perhaps it's a positive thing, but more money is a challenge to investors. Do I believe that this is going the way it should do? And if so, do I back it further? So we haven't had any failures yet, but we have had companies that have underperformed against their plans. And indeed, we've had 2 companies that have had to come back to investors for more money. So what went wrong? I think with hindsight, it's very easy to say that the management's plans were too optimistic, usually in terms of what would happen to sales growth. Looking back, that's easy to say. Going forward, I mean, our lesson is that we have to constantly, on behalf of investors, add a little bit of pessimism into forecasts. And we won't always get that right, but I think we're learning every day. Yes, we do. I certainly invest in them, and many of my team, and indeed the wider partners of Rockpool invest. Really, it's a question of openness. We've tried to bring a new level of transparency to EIS investing, and you can see that in the reports that we put out before investments are made, and in the quarterly reports that follow each investment. Indeed, there's an opportunity for you to engage directly with each company in your portfolio if you want to do so. And we find that's a really dynamic relationship. We get investors feeding back to us their thoughts, their questions, and actually that keeps us on point. It gives us ideas to improve investments and also helps us avoid risks. So I would say transparency is what makes Rockpool different. And if you decide to come with us, you can choose to go with the managed service, which is a really easy, simple way, or the self-select service, where you can actually choose every investment that you make.